Thursday, January 27th, 2022, Monaco 64, home of alternative economics and contrarian views. So the Fed has hammered another nail in the coffin of the purchasing power of the dollar. Yes, the Fed didn't really announce anything specifically in terms of interest rates or QE yesterday. The important part of the FOMC meeting yesterday was not really the announcement, but the press conference afterwards, where Jay Powell makes an introductory statement. And in that introductory statement, he gives the excuse, really, for the Fed basically having destroyed the purchasing power of the dollar by over 96% since it started operating in November of 1914, as you can see here by this chart. Why November 1914? Most people think the Federal Reserve System was started on December 23rd, 1913. Well, that was when the Federal Reserve Act was passed into law, but the New York Federal Reserve Bank only started operating in November of 1914. And the New York Fed really is the regional bank that runs everything. They've got the most powerful banks owning them, the Wall Street banks. So yeah, what's his excuse for not really looking after the purchasing power of the dollar? Well, it's that Congress has given the Fed a mandate of full employment and stable prices. And of course, this loss of purchasing power by 96.34%, that's the exact number. If you look at the chart there and you do the calculation for the latest data. That has been very gradual, as you can see, but I think the last 3.6% or so could be very quickly. What the Federal Reserve doesn't want is a strong dollar. As you can see, that happened in the 20s and 30s, and that was a problem for them, because that means the general public are working for a sound currency, their stability, they can plan ahead. And the Federal Reserve doesn't want that, because the Federal Reserve is a communist institution. And why do I say that? Well, because one of the planks of the Communist Manifesto is centralized credit. And in the communist system, you have basically the party, the Politburo running everything. And I would say Jay Powell is a creature of the Politburo. He's a DC swamp monster. He was even born in Washington, DC. There's very few people that you see around that are born in Washington, DC. He worked for Dillon Reed, a major investment bank on Wall Street. I think Douglas Dillon, I think that was his name. He became Secretary of the Treasury, or Robert Dillon, I'm not sure, under either Reagan or Bush. And then he went to work for the Carlyle Group, which is the Bush's private equity group. It's also a private equity group of which John Major, the Prime Minister of Britain, who went along with the first Gulf War in Iraq with the Americans, has also been chairman of the European arm. So that's what Jay Powell represents. He represents the oligarchy of the American Soviet system. It's not a free market. If we really had a free market, we wouldn't have a central bank. And we would have, sound money, most probably, because most people would want to get paid in something that holds its value, in a currency that, or money that they can plan ahead, They start working, let's say at 20 or whatever, and they plan, well, if I work hard for the next 35 years, I'll have this much, I'll be able to buy this much, I'll be able to put this aside. But nowadays you can't do that. The only way people have been able to protect themselves from this inflation is through speculation and through being very wealthy, because the wealthy, they have the wherewithal to protect themselves against the inflation. For those at the bottom trying hard to survive, inflation or rising prices really affects their disposable income because they spend most of it on necessities. And Mr. Powell, Chairman Powell yesterday noted that, but very superficially. He said even the wealthy get hurt. Yes, their food bills and transportation costs will go up. But he didn't mention the fact that the wealthy are able to become even wealthier at the expense of everyone else. And is it any wonder that when the major bankers of Wall Street and Europe and their representatives met at Jekyll Island in 1910, is it any wonder that those people who met represented about 25% of the world's wealth? And I would say that proportion has gone a lot higher. They're the 0.01%. And yes, they give lip service to ethnic minorities, that they're doing better and better. But I mean, I ask you, wouldn't it be better to get paid in some kind of currency that is sound and honest, and to have very little taxation, to have small government, to have the government actually impose a proper rule of law and people trusting each other more and doing more business? I would say that's much better than the Keynesian paradigm we're under. And unfortunately, the major learning centers or universities in North America, in Europe, they've been, of course, captured through through the bankers' endowment, and it's all part of it. They've focused the education towards a Keynesian paradigm in which people are told that government has to do something to help the economy. And that's the whole problem. And unfortunately, that's why Congress and Parliament, they vote through these really acts or laws that seem good for the people. Like, I think the one that Powell mentioned yesterday was passed in 1980 under, or early 80s, Full Employment Act. It sounds good, right? But it has the opposite effect. And don't believe in their statistics. Unemployment rate is very low, but the labor market participation's the lowest it's been since the mid-70s. So things are not that great. So yeah, how did they get away with it? Well, because the leaders, the politicians, the congressmen, congresswomen, MPs, they've all been indoctrinated into thinking that they have to do something. Most of the voters think the same way. So why am I the opposite? Well, I was educated under the system, believe me. But I was fortunate enough to find the Austrian School of Economics and sound money. And there are exceptions in Congress. Ron Paul was one of them. Right now, there might be one or two. Even here in the UK, in Parliament, there's a MP called Steve Baker. He's a conservative, so to speak. But he made a speech about sound money a few years ago. But sound money and honest weights and measures, a small government, low taxation, rule of law, doesn't interest these people because they're statists. So what did Powell say yesterday that convinced me that the Fed doesn't want to save the dollar or the purchasing power of the dollar? And by the dollar, I mean the fiat dollar, because many of you know that the definition of a dollar is a weight of silver and gold. Unfortunately, that has been all corrupted and confused. And I use the term dollar, but I actually mean the Federal Reserve note. So I tweeted out because I was listening to the press conference, and the important part of the press conference is not the introductory statement by Powell, it's how he answers the softball questions from all these reporters from mainstream media. Yeah, they're mostly softball. They're all there working for Bloomberg or New York Times or AP, and they are in this Keynesian paradigm. They can't see things in another way. But Powell said in reply to one of the questions, and I tweeted, Jay Powell says he doesn't want to drive inflation below 2%, but wants to have an average of 2% over time. How is that possible? I said, when we are seeing CPI at 7% plus. Looks like the Federal Reserve will keep stealing from the public, hashtag and the Fed. So yeah, if we had 7% CPI in 2021, technically, if you wanted that average to go back to 2%, at some point in the next few years, we'd have to see CPI drop below 2% for a considerable amount of time. Because it would be impossible if we keep CPI above 2% to get that average back to 2%, because we've had 7% last year, and I'm sure we're going to get a lot more than 2% this year. So that's what the Fed's real intent is. Of course, Jay Powell is a very slick operator, and that's why he's up there as chairman of the Federal Reserve. He's very slick, very deceptive. Deep down, he's a swamp monster. Deep down, he's protecting the very wealthy, and he's part of that group himself, even though probably not as wealthy as some. So that's all you need to know, in my opinion, about what's happening at the Federal Reserve. They're not there to help you, the general public. As you can see by the chart here of the purchasing power of the consumer dollar, it was really accelerating lower back in the 70s and early 80s. And then we had someone called Paul Volcker who came into the Fed, and he was a swamp monster too, worked for the Rockefellers. The guy who advised Nixon to close the gold window. He came in and let rates go to 20%. At the time, of course, the national debt was only 35% of GDP. Now it's almost 140. So he was able to avert the complete meltdown of the dollar, the fiat dollar, but the purchasing power has still been declining, and I would say it's been declining a lot more because they've tinkered a lot with the statistics. So I would say we're in real terms we're more near the last 2 to 1% of the dollar's purchasing power, and what they don't want to see is what you saw in the from 1929 there to 1933 is the dollar strengthening. And you might say, well, that was the Great Depression. Yeah, a lot of people got hammered during the Great Depression, especially the bankers and the speculators, the people who went along with the Wall Street game, with the speculation, and also through keeping a lot of their savings in the bank. A lot of people lost a lot of money, not from the stock market, because the banks failed, but people who had their savings and assets outside the banking system, they did very well because they could buy a lot more. So they try to portray the Great Depression as a bad period, but it was a bad period because the bankers were under threat. They hate to see a currency appreciate because they have a lot of liabilities. That's how they run their system, with a lot of leverage. So with that, let's quickly look at where the markets are this morning. It's just before 9 a.m. London time. We've got spot gold at 1814.40. It's down just over $5. Range has been 1822 to 1809. Spot silver is down 25 cents, 23.27. High's been 61, the low 23.08. The Dow futures is down 88, or 1/4%. The Nasdaq 100 future is down 1/4% as well, and so is the S&P. Well, S&P futures down 1/3 actually. The FTSE 100 index is virtually unchanged at 74.80. To the fiat currencies, sterling is down 1/4%, 134.30. The euro is down 1/3, just above 112, double O. The dollar's up 1/4% versus the yen at 114.91. And the dollar has rebounded quite sharply versus the yuan. Yesterday we were trading at a 632 handle. Right now we're at a 636 handle. We're up 0.5%. Again, it doesn't matter what fiat currency you hold. The dollar might be strengthening right now, but in the long run, they're all going to go to zero in terms of purchasing power, because the dollar is the base of this system, and all other fiat currencies are a derivation of the fiat dollar. To finish off here, the Aussie dollar is down 1/3 as well, at 70.88. The dollar is up slightly versus the Canadian dollar, 126.77. And the Kiwi dollar is down 0.5% at 66.15. So the markets think that Jay Powell was really hawkish, that he's going to do so much to rein in the inflation, and they've been talking about this, the Fed and Jay Powell, for months, and still they haven't done anything. Actually, they're just like managing perception, so to speak, with the markets. It will be very interesting to see what really happens in March, if they really start a series of rate hikes. I have my doubts, but who knows? Anyway, to the commodities, we got WTI crude down 1/3% at 86.70. Brent crude, I heard yesterday went up to 90. Right now it's 88.57. We don't look at Brent that much. High-grade copper is down 1% at 447. And yes, the bond yields went up quite a bit, or note yields as well. The two-year yield, two-year note yield, has gone up from like 0.75% about a month ago, and right now we are at 120. So it's up about 10 basis points overnight. I think it went up another 9 basis points. Well, that's the market saying that they believe the Fed is going to raise the Fed funds rate in March and going forward. The 10-year yield also went up about, I think, 9 or 10. Right now it's unchanged at 1.84%. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to this channel if you haven't yet. And you can also follow us on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.